Hey everyone, after the stupendous run in the big REITs, big real estate investment trusts of the Capitalands, Mapletrees and Frasers at the point, you'll be asking what's next? Well, in this week's video, I'm going to share with you two mid-cap REITs which I reckoned when the time is come, and the time has come for them to be zoomed. Well, they share four characteristics. That is, one, they are what I call Steady Poom Pi Pi. Yes, just like the structure there. And when the share prices run because of a few catalysts which will highlight, it doesn't just snow, as you can see from here. You get a blizzard. First, these two REITs share commonalities. One, they have listed in Singapore for a very long time. One is for 5 years, the other one is at 20 years. But there's a misconception on the market about these REITs. For example, one of these REITs actually have will, that is, tenants paying them and signing rental agreement with them for almost 10 years. Yes, ladies and gentlemen, you have leases that it's almost 10 years. Now, how stable can it be? Two is that they will benefit from the downside fall in interest rates, which means that their cost of funds continue to go down, DPU will grow. So like I say, when it snows, it doesn't just snow, you get a blizzard. Thirdly, you have a possibility that with rentals being so stable, and it is indexed to the inflation. If inflation goes up faster, the top line will also grow. And fourthly, ladies and gentlemen, that this characteristic of these two REITs that we have and are going to share in this video is that we know this management well. Not only just us, but the investors at GCP Global, because they get direct contact with the management. And guess what? Like we always say, we never waste our saliva on the snow. We put our money where our mouth is. So once again, you want to make big money, you don't need to take unnecessary risks. You just have to come in at the right time, come in big, and know when is it going to snow and when the snow becomes a blizzard.
United Hampshire REIT. Do you know what does this REIT do? Well, it is probably the most misunderstood REIT in the Singapore REIT market, and I do not blame you if you have not gotten a full understanding of what do they do. But it is doing two particular sectors that is actually in strip malls and in self-storage that are the strongest real estate class and subsectors within the US market. Yes, I know, ladies and gentlemen, many analysts have highlighted the bigger REITs, but this misunderstood REIT is about, as you can see from the chart, to break up from the 54 cents level. At GCP Global, we told our investors to be buying and we're sitting at 20% profit gained, but waiting for the breakup at 53 to 54 cents. Let me share with you four reasons why we reckoned that United Hampshire is a REIT that you should be considering for a breakout baby to happen. First, it is a Steady Poom Pi Pi REIT. It fits into the category. And why is it so? Look no further, ladies and gentlemen. In this chart, they own strip centers. What are strip centers? Hey, I have many over the years, encountered many people say, naughty Gabriel going to strip centers. Well, if you have worked in the US like what I did in Wall Street in 1996 to 1998, right up to living in Connecticut during that period of time, you will understand that a strip center in the US is nothing to do with a strip club, like a zebra club where you get to see interesting ladies dancing lap dances. No, strip centers are nothing of this sort. Strip centers in the US are essentially somewhere suburban on the connection of street consultancy, which says that actually, the strongest real estate class in the US, is number two, the strip centers, and within strip centers, so they classified retail centers from A, B, C, as well as strip center. And strip centers are the second strongest, because they are powered by stable, bumpipi, grocery anchored kind of tenants. And look no further, ladies and gentlemen, the average supply growth in this subsector is really, really very low. If you look further at the third arrow, you can see that the year-on-year growth between now until the 2029, you're going to see the lowest growth in terms of supply on strip centers. Now, this speaks well for the outlook for United Hampshire REIT, a REIT which I consider a Steady Poom Pi Pi, very misunderstood in this part of the world. Secondly, if you look at the best performing real estate sectors in the US, and this has been the case for the last couple of years. Surprisingly, industrial is number one. Number two is self storage, for which United Hampshire has two assets under self storage. And thirdly, it is strip centers. Now, compare this to office market where the likes of your Capitalands REIT or your Manulife REIT is actually being pulled down in that particular sector. I think many Singapore investors fail to understand that what is happening in the US office market is a total opposite of what's happening for strip centers, and in this case, United Hampshire REIT in Singapore. So that's why I have reckoned it as one of the most misunderstood REIT, and therefore a misunderstood share price, which, as you can see from the chart, is probably about to break up at 53, 54 cents. Now, the next thing that is misunderstood about United Hampshire is its high occupancy rate. Yes, ladies and gentlemen, their biggest customers are the likes of your Walmart, your Target, and the big grocers like Dollar Tree. And you can see that their occupancy is hovering almost close to 100%. That's 97% as we speak. For the grocery and necessity, their self-storage is 95%. And that part of the world, that's the US market, where Trump trumps in many ways, whether it's rhetoric, narrative, or jokes. Getting almost 100% occupancy for their properties is remarkable, ladies and gentlemen. And this is where United Hampshire scores. But yet it is misunderstood in this part of the world. And that's why the share price is being depressed unnecessary. Is it a good bargain? Left to be seen. Now the next point is that which REIT sector in Singapore has clients that pay the REIT for almost 10 years in terms of rental? Well, United Hampshire fits into that. Its WALE for its top tenants is 9.6 years. That's almost 10 years. Now, most of the time when we speak to fund managers, we speak to analysts, we ask them which particular REIT has the longest WALE. Most of them do not understand or fail to identify United Hampshire. That's why I mentioned it's a misunderstood REIT. And as usual, at GCP Global, we specialize in bringing such REITs, such stocks at attractive prices to you first thing if you come to our classes, the next of which is on 7th of February. Yes, I'm going back next week to teach this class before coming back again for the snowy season. Now, ladies and gentlemen, the fourth reason why we are confident in presenting United Hampshire as a this misunderstood REIT is because of these years. You notice that we love to sniff out good bargains. And when they have been in bargain level, going down to 42, 44 cents, we've been scooping up the stock. You can see that we have followed up over the years with its CEO. That's a total gentleman, in striped in the first pair. That's Mr. Gerard Yun, and then next to him is the lovely lady, Miss Wong Siu Lu, the head of public relations. In the second photo, you notice that we have had occasions when New Hampshire management hosted together with GCP Global, yes, we do host events where the CEO gets close to the investor so that he can understand the investor's concern. In the second photo, we actually had the privilege of Miss Naveen from Business Times joining us. And then the third photo, as you can see, Pips, Mr. Gerard Yun next to our longest attending student. That's Mr. Kenny Tan, the one in white beard. Yes, I've seen Kenny from black hair now to white beard over the last 30 years. Yes, he has been attending our classes for the last 30 years and will be teaching this year for 37 years. As usual, we do not just babble and grumble. We put our money where our mouth is. And this is the CDP statement, the latest one, and you can see, ladies and gentlemen, that, my stake in United Hampshire, is standing, according to my CDP statement, 702,819 shares. Now, that value is 525. Right now, it's going to be 53, 54. So my stake in New Hampshire now is about closing in on 400,000. Yes, ladies and gentlemen, for you to make big money, it's very simple. Identify good REITs selling at identified prices, particularly when they are misunderstood. But at the same time, their fundamentals are what I call steady boom pi pi, and buy them big, buy them early, especially when they're about to break out at 53 and 54 cents. Before I move on to the second stock, ladies and gentlemen, I just want to tell you that this video is not about recommending stocks or it's not investment advisory. All right, it is just my personal sharing of the positions that I've accumulated in many of the various REITs. Now, for those of you who do not understand me, you notice that if you look at my history, you can Google me, you notice that I was Singapore's head of research, probably Singapore's youngest head of research at Nikko Securities at the age of 27 years old. Luckily, I made enough money after working in Wall Street and working and heading various dealing director posts in Singapore, and I retired in 2009. And the basis of my wealth accumulation is through precise, solid stock positioning way before the prices move. And that's why if I think I can make my millions from there, I think you can actually do that as well. And that's why I distill it in my book that is the bestseller, Making Millions in Real Estate Investment Trust. Do read upon it if you haven't done so. And moving on, again, the next video is going to talk about another Steady Poom Pi Pi REITs. The basis of my wealth accumulation all these years is to position early into Steady Poom Pi Pi REITs or stocks. Let me just share with you what does Steady Poom Pi Pi means for you, the investor.
Walking through air.
So Steady Poom Pi Pi means having the knowledge, having the capability, because you do assiduous research, detailed research, cross-analysis to know that the stocks as well as the REITs that you are buying are of good quality and buying in a big manner and at in appropriate time. Now, moving on to the second real estate investment trust that we want to talk about today is this real estate investment trust that has been listed in Singapore for already 20 years. That's AIMS APAC REIT. Looking at the chart, ladies and gentlemen, AIMS APAC REIT is about to break up from its long-term 10-year resistance of 155, 160. We reckon that with interest rates on the way down, they have a very good chance of being able to break that out for a long time. One thing for sure, other than the same reasons that they share with United Hampshire, AIMS have the other few reasons that one should be interested to be looking at AIMS. One is the fact that just recently, its new acquisition, AIMS APAC REIT, has aimed correctly. They actually went on to buy this property called 2nd Aljunied Avenue. Now, no research in the press, no research from any of the analysts have highlighted that if you look at the NPI yield of this acquisition, it's like, my goodness, ladies and gentlemen, a very high 8.1%. Let me just turn the ball and ask you, when was the last time any Singapore REIT made an acquisition with NPI yield above 8%? You would be like scratching your head. Oh my God, ladies and gentlemen, it must be more than 10 years ago. So in this acquisition, AIMS APAC REIT has definitely aimed correctly. Now, what's interesting also is that this acquisition has the traits of many good acquisitions, which were in the vogue in the earlier years when the Singapore REIT market came out. Now, it's only in the last 15 years where the market has been spoilt by many of the wanton acquisitions made by many of the REITs have then subsequently underperformed. So going back at the template of AIM's recent acquisition, which we tell you they have aimed correctly, is a few traits. One, it is they have acquired attractive property at an attractive yield and an attractive DPU accretion. Two, it is a quality industrial asset. Okay. And thirdly, the tenants of the property, that's where you are buying the property from, are of good standing. All right. So numerically and mathematically and quantitatively, what does it mean for the REIT? It means that the DPU, the pro forma, would have been increased if the acquisition was done at the beginning of the year. And the DPU accretion is a high 2.5%. Now, compare this to recent acquisition by other REITs. You notice that this really is a standout. Okay? And most importantly, after the acquisition, ladies and gentlemen, what is the gearing ratio of AIMS? Huh? Look again. It's 30.8%. Barely up. All right? Now, this means that AIMS is in a steady Poom Pi Pi position. Remember, steady Poom Pi means effortlessly to be able to cut through the air if there are further attractive acquisitions come along for this year. After all, if we look at the financials of AIMS, other than aiming correctly, they have also positioned correctly, because if you look at its occupancy levels, you notice that they are the fourth highest in the industrial sector. And in terms of reversionary rentals, based on the last quarter set of results announced by its other competitors, AIMS APAC REIT has the highest, strongest rental reversions of 14.3%. Of course, we look forward to the fact that they will continue and are able to be able to deliver on this strong reversion rentals in this upcoming results next week. And by the way, we also know the CEO well and know enough since he came on board already 4 years. We have constantly kept up with him, and that's why we invited him to be our fire chat speaker on our next class on 7th of February 2025. Come and hear him, because he's been an honest guy, he has been straightforward, he's being even direct, and most importantly, be able to share the common difficulties in running industrial REITs like AIMS APAC REIT. So do join us for our class on 7th of February. And by the way, as we have mentioned to you, we reckon that as interest rates fall, the rally in the big cap REITs will spread to the smaller cap REITs. And that's why you notice that we have been catching up on lunches with the various REITs, the recent of which is the newly listed Centurion REIT. There will be more of these ideas to come, so do subscribe. Stay informed to our channel so that you can't can continue to be a steady Poom Pi Pi investor just like us, meaning do your homework well so that you can cut through effortlessly all the noise. Once again, have a good week ahead.